what is my bigger thesis about the markets and how things are actually playing out. And really, we had a very interesting weekend because we had the Opex. Now, last week it was relatively important because last week we did have the options expiration for September. Now, why is this significant? Well, if you go back to the summer, everybody was thinking that the period where the market was most vulnerable, including myself, was going into the September month, because historically, from a seasonality perspective, this is where a lot of market events happen. You know, everyone gets back from Labor Day. We had a Fed meeting. Everything was showing, potential room for higher volumes. Suddenly, the stock market potentially goes through some sort of a correction in that window. So a very large amount of market hedging was going on into that September expiration. We had over $5 trillion of notional exposure on the S&P 500 of option, no, sorry, on the markets as abroad. 3 trillion of that on the S&P 500 index. That notional exposure just all expired over the weekend. And this is incredibly relevant because when we're getting to the tail end of an option expiration, the gamma starts to rise on a lot of these at the money positions, which basically means dealer flows have an increasing influence on the flows into a market. And so when you're talking about the liquidity, there is often what is known as a gamma pinning going on, where if a market was to sell off, dealers actually, just based on delta hedging, would actually initially be buying back shorts into that, which actually causes the stock market to rise, and then subsequently sell into strength. This causes what is known as gamma pinning. And these flows in the market influence and hide what is actually happening with the rest of the market. And so as all of these hedges expire, and all of that gamma influence unwinds, the stock market is free to actually now trade in trend. And this is what makes this super interesting, because now think of it like the leash on a dog. Suddenly you drop the leash and allow the dog to go free. In the same way, the gamma pinning is now out of the market. And more importantly, we're past this Fed and the initial reaction. And so now the market has so much room to begin a trend move. The puzzle to solve is, which direction can that trend move be? Now, obviously, anybody that's been following me knows that I am concerned about the short-term place where we're in the market. Now, I don't want to talk about the word market crash or something like that. I want to talk about corrections, and in fact, I'm gonna put a video out on market corrections here in the week to come. But I want to highlight that we are right now in the 100th percentile for this decade, going back to 2020, for what has now been the longest and the largest in magnitude rally without a 5% correction. 100th percentile. We have not had, this has been a 168-day market rally off the Liberation Day low. And it's been a 36% rally. You have to go back to end of 2023, 2024, where we had like a 158-day rally that was like 29%. That was the next longest one. And so now that in itself doesn't guarantee a market correction, but it does highlight that at least we are in the late stage innings of this market advance, and way overdue for the stock market to pause and revert. Now, think of it this way, and we'll talk about another thing, but market corrections throughout this past decade have happened just over 4 times a year. That's corrections that were greater than 5% in their magnitude. That doesn't make it a market crash like a Liberation Day thing, but it's a period where the market resets and actually has some sort of reversion that allows the asymmetry to reset and new buying opportunities and to emerge. Often, if it's only one of those 5+% market corrections, it's almost not worth even market timing in a sense that you don't always need to automatically liquidate. The one thing I'm definitely saying to members is that this is not the time to be putting new money to work, right? If you have some long-standing investments and you want to hedge them out or do something, this is fine. But if you've got a brand new wad of cash, it's at this point increasingly beneficial to wait for some sort of a correction in order to get a better asymmetric starting point for any potential new investments. Okay, so what are some of the things that we're seeing that make us believe that this is ninth inning? First of all, a number of measured moves on the upside are finished. I'm just going to, for instance, highlight this measured move. Sorry, let me just correct this. Like there's this measured move right over here, and then there's this measured move right over here. These two measured moves on the market are actually we're targeting these upper zones of this market advance. Now, as measured moves finish, again, that doesn't guarantee to a day when a market correction is done, but it does show that that when you follow rules of symmetry, that this market is in the late stages of a short-term advance. But there are other things that are short-term concerns. One is the deterioration of market breadth. And this is something that I'm always looking for before a market correction. To put it in context, back in June, July, when the stock market had an 80% breadth when measured by the number of stocks in the S&P 500 that are trading above their 50-day moving average, which I love as using just as an arbiter of trend. And so we have now seen a scenario where while the S&P 500 made higher highs, we have now deteriorated down. At one point, we were just trading at 50% of stocks above their 50-day moving average. We bounced a little bit back to 56%, but a sequence of lower highs and lower lows. This entire rally continues to be reliant on a few big mega cap names to keep punching it higher, to really bring home this outperformance of this and how thin this leadership has been. What I have here in the purple line is the S&P 500 equal weight. So we're taking all 500 stocks, giving them the exact same market cap weighting into the cash index. And basically, since Liberation Day lows, we're up about 23% on the equal weight index. Now, to narrow that from the S&P 500, I wanted to narrow down to only the 100 largest stocks through the S&P 100. That is up in the black line 38% off the Liberation Day lows. But when you take the MAG 7 based on the MAG's ETF, that is up 60%. But more importantly, it was been the place where the accelerated returns have happened over the last month, while you can see the equal weight index has been relatively flat. And so we have breadth deteriorating as that leadership group has actually been where the returns have been made. Now, we'll talk about what I'm watching for potential reversal signals in just a second. But what I want to really do is just highlight something on the Mag 7s themselves. Okay, so right off the bat, I want to just touch on, let's say, Apple. And first of all, Apple did make higher highs, and it actually does have a measured move that goes for a retest of its previous highs. This is probably one of the few Mag 7s right now that actually you can still make a pretty good bull case on for some short-term momentum. But then when I want to then move on and touch on, let's say, Amazon. Notice that Amazon has lost all momentum. There's divergent momentum, a lack of follow through. You're just not seeing Amazon at all participating. Then you go into Meta and Microsoft. And so let's start off with Microsoft. And while this could be a flagging formation for a bull turn up on here, well, often topping formations have some sort of a key top retest. There's always room for Microsoft to make a little bit of an impulse here. But generally, Microsoft has not participated. And even then, when you look at Meta, it's just now retesting its highs. The momentum over the last 2 weeks has not been much. So this has very much been driven and concentrated into Google, which has been absolutely on fire. This has been an absolutely extraordinary run. And so right now, almost all of this money has been piling in there. And at the same time, you have basically Tesla having had made this bull move, and even from a symmetrical move, has now even finished this measure move, while I certainly won't rule out a short-term impulse to retest those December highs. Point here is that when you're looking at what will be the next incremental thing to contribute to the S&P 500 and the Mag 7s going higher, maybe Apple doing a little bit more, maybe Microsoft retesting its highs, but you can see that generally even the Mag 7s have really thinned out, even though they have not technically broken down. I wouldn't want to call any of those charts outright bearish by any means just yet. So the S&P 500 being down 20 points in this post Opex, we want to watch into today's market open whether something changes after this big options roll off. And so what I want to highlight is I think this becomes super simple for to analyze. I'm going to put it on a 4-hour chart so we can really zoom in on the S&P futures, right? So this is not the cash index, but futures, because this is 24-hour market, so we can be able to really kind of size up some of this intraday move. But I want to highlight that you can take this ascending trend line and observe this rally that happened in the post FOMC reaction. Now, if this market was going to do something bearish, which it has not yet, I want to highlight that I'm not here saying that it officially has started, but the warning sign, you'll hear it from me, especially my members will hear quite a thing, is that if for whatever reason a sell-off was triggered here that wiped out the entire FOMC rally, basically bringing us back to 6,600. If we have this as like a prairie dog fake out on the upside that is essentially fading off of its FOMC rally, that in itself is a really good indication that there's some sort of price action deterioration. It was a potential fake out rally and everything like that. So now that's almost 100 S&P point drop to see that price action deterioration. So this is there has to be some really kind of heavy blow to the downside of this market to turn this. Now, the analogy I want to offer is to use American football, which is I always like to look at and say, are the Bulls or the Bears in possession of the ball? Because the one that's in possession of the ball, even they may lose yards, is the one in control and trying to make ground and make the drive for a score. In this analogy, I want to highlight that the Bulls have been in possession of this ball, and actually today are actually still in possession of the ball. It's theirs to lose. So what we're looking for is those clues that maybe there's a turnover or somehow the Bears have taken possession and that the script is flipped. And this is definitely, so we know we have divergent momentum like we just talked about. We have all of these types of things that are indicating that this market is way overextended, and momentum divergences and all these different things developing. So now the question is, will we see something emerge in this market that shows that breakdown? And that you want to even just simply taking the Fibonacci of the advance, you can see that 6,660 is where the 61.8 fib is, and that's right along that 50 period moving average for on a 4-hour basis. And that also could be a very good little thing with indicator level, which is that look, if all dips are being bought above that level, then you stay in bull trend and accept that there could still be one more impulse towards 6750 or something higher like that. And only if it breaks down below that level would be where I would be starting to get concerned. So now I want to move on that. So again, we talked about this. The S&P overextended, but not yet giving a negative signal. I want to move on here, and I want to talk about the dollar. And particularly, actually, sorry, I want to just quickly pull up this chart. And what I want to highlight here, and this was a great post that was put out there on the internet, and it was just showing the US dollar performance into and after the first Fed rate cut. Now obviously one is with a recession and one is without a recession showing. But generally, what you can observe is that the US dollar surprisingly strengthened in this period. Now, of course, many will make the argument, well, it's different this time, and Trump wants a weaker dollar, and so he'll get what he wants, and you can make all these types of arguments. But I want to simply highlight that we did see in this post FOMC the US dollar bounce, and a bounce came at a very key moment, because going into the FOMC, we were on the verge of a breakdown to a lower low. And that would have been a big deal, because on a weekly chart, you can observe that if that breakdown happened, I mean, we would be it's like falling off the edge of a cliff. The dollar really wouldn't have much in its way for doing another, 8% decline going back to 2021 lows. And so we were at the edge of a cliff. And in the post FOMC, it bounced. Now, is there anything significant to this bounce? Well, not yet. We have the bounce hasn't even beat a basic here. I'll put on a 4-hour chart. Like, it hasn't beaten its basic fib zone. It's just actually been testing its 61.8 as we speak. It hasn't gotten above the moving averages. So arguably, if the dollar just weakened right back down to the lows, while the primary downtrend is still intact and the vulnerability of a breakdown is still very much there. And so I'm not yet calling for a dollar reversal, or at least technically there's no evidence that a major dollar reversal has happened. But there are some very key technical levels to watch, and that key one is now the 98 level. And it's not just because that 50-day moving average is there, but after you have this kind of a retest of a low, if you have a reversal that wipes out the entire last round of selling, those are the signs that the currency has reached what is known as like a fair value zone, and that this could actually be a baseline from which the currency actually stabilizes. Now, have we seen that yet? No, but this is actually a very critical technical level to be watching. What I basically would say is keep it super simple here, is that if it stays below the 98 level, you stay with the respect of the prevailing downtrend being intact, and consider a break above the 98 level to be an indication that there could end up being counter trend movement the other way, and that's going to be key to watch. The one interesting thing that I wanted to highlight was there was a prairie dog on the euro, and the prairie dog basically was a break to a higher high, and more importantly, in the next 48 hours that followed, it gave out the entire breakout candle, which often is an indication of a false start. Now, again, have we broken below a Fibonacci level on the euro? Have we broken the 50-day? Nothing yet. This is why I'm still watching very closely, but I want to make sure it's very clear that this is a very important moment on the currency side for this. Now, I want to talk gold, but before I do, I'm just going to give lip service quickly to Bitcoin, which broke down 2,300 points on the downside, but it's actually quite relevant where the breakdown happened from, which is when we had this breakout of this descending trend line and got back above the 50-day, the one hurdle I wanted to see beat was the fib zone, which is proved to me that this wasn't just a retracing bounce for a continuation down, and that in fact a bull trend resumed. And yet it made a perfect 61.8 retest into that 118,000 level. And today's breakdown candle broke below the 50-day. Now, it's not enough for one day doesn't make a new trend, but if we don't see the bulls recover this breakout candle in the next 48 hours, then we are highly vulnerable that this is still has one more corrective leg, and that corrective leg of a zigzagging pattern would have Bitcoin going to retest 100,000. Now, I want to highlight that that doesn't actually even make it a bear market. That would just make it like a 50% retracement of the bull move from April to July. I mean, after a correction like that, it could still actually bullishly break out on the upside. The key thing that I would highlight here is we're just trying to determine whether there's one more corrective leg in Bitcoin to the downside, or will the bulls stay in control of it above the 50-day and make a breakout above 120,000 to make that $130,000 target on the upside in play. And so that's what I want to watch here. So the last thing I'm going to leave all of you with here is I want to just touch on gold. And then gold started this whole 2-day market correction, dipped down a little bit. There was a bearish engulfing candle on the GDX. And the question was, were we going to see a correction in gold that was a little bit deeper? I mean, and in the end, certainly there was room for 100+ point pullback in gold. But I want to highlight that gold remains primarily a bull market. One thing we've been very clear with our members at Big Picture Trading is that measured moves are all the way up towards 3,900 to 4,000 on the upside. And now, if this little tick here proves to be a real breakout and that becomes a midpoint, then a short-term measured move still easily marks the next advance to the upside there. So while the sentiment is decisively overly bullish, there's a lot of people that are already talking about how frothy this rally has been, but I don't necessarily think that this exponentially sharp bull run is necessarily over just yet. And so let's see whether today's breakout candle fades or whether it's for real. I always say the breakout candle one day doesn't make a new trend. It's always what happens in the 48 hours that follow. That's key, and that's what you got to watch on gold here is to stick, because there's lots of upside still left if this breakout is for real. And so that's the thing to watch there. If you like this kind of analysis, this is what I do with my members all day long at Big Picture Trading. So make sure to try a free trial with us if you want to get this kind of information every single day. But otherwise, everyone have a great trading day. Cheers.